Hi, Tim Bigham back again this week for Traders Exclusive, and so far a very ho-hum week to say the least. Certainly different than what we saw, about a month ago with heightened volatility. Almost the exact opposite today. We're seeing the market showing a little weakness, even though it's a Tuesday. If you look back so far this year, Tuesdays are up about 8%, not Tuesdays down about 6%. So it's paid to been long Tuesday and short the rest of the day so far this year. But a little weakness today, certainly on the earnings front. We're seeing numbers out of Home Depot that came in light on the top and bottom line, although they did up the guidance, and the stock actually opened lower, but rallied up sharply. That stock down about 8% or so this year so far, and kind of highlighting the fact that even in this low interest rate environment, we're seeing 10-year yields approaching that 2.5% level. Not too long ago, we were up around 3%. 50 basis points may not seem like a lot, but that's a 20% basis point move on the 10-year. So, going from 2.5 to 3, and given the fact that rates are this low, to seem the home builders, certainly struggling here, and also the home builder related stocks such as Home Depot and Lowe's also having issues, Masco and the like, I think highlights the fact that, low interest rates may not be the panacea for an economic recovery. Certainly has goosed the stock market here on a comparative basis, but even that, I think, is running into a little bit of wall of worry. But complacency reigns supreme. Mentioned lowest volume day of the year yesterday in the stock market. We have the VIX trading down in the mid-12s again. In the past 2 years, anytime it's broken 12.5% has been a pretty good signal that stocks have gotten a little ahead of themselves. So went back, did a little work last night, and if you take a short position on the SPY, anytime the VIX traded below 12.5 for the first time, and got out of it 5 days later, ended up being a pretty good trade. We're also, approaching almost those levels on the VIX that we really haven't seen since early 2007, which really marked, the big high in the market going forward. So I think fear has become a forgotten word here, and because of that, I'm positioning on a trade in SPY. Given the fact I can buy next week at the money, SPY puts with the SPY around 188, buying slightly in the money puts the 190s at a 8.5% implied volatility. I've been in trading since the mid-1980s. I have never been able to buy an S&P 500 option in the 8.5% implied volatility range. To me, that is just dirt cheap. I'm hedging low, selling this week out of the money puts on the 188 puts and receiving about a 10.2 implied volatility, paying about $1.45 on that spread. So any kind of pullback in the market, we're finally getting one today, should prove a benefit for this. And buying options at this cheap implied volatility level, I think it really can be a double-edged payoff here. You not only, if you're right on direction, but you'll be right also on implied volatility. So I think things have gotten a little too cheap here, especially given the fact high yield has had a bad year, which is normally highly correlated to stocks. Earnings certainly have not come in good. Revenues definitely on the light side. So if you look at Warren Buffett's favorite metric, which is GDP to stock market cap, it's flashing warning signals, the highest it's been since really the crash of, the NASDAQ mania. So we're into areas where stocks are no longer cheap. Options really are. So I really favor some, kind of put buying, put diagonals especially, buying, a couple weeks out, selling front week, capture some time decay, position slightly bearishly. Timing can be difficult in this market when it just keeps to be inexorably, climbing higher, but just wait for that one bad hair date, able to take off the trade. So until next week, this is Tim Bigham, and even in this kind of complacent market environment, I think it's more important, keep your position sizes small and your stops in place. Take care.